I'm Sonali Basak, and this is the next big risk. It's the job of a financial executive to calculate the unknowns. Geopolitical tensions are rising across the globe as conflict engulfs countries in the Middle East and Europe, and concern builds around Taiwan and China. Investors are also uncertain about the state of the economy and a divisive presidential election in the U.S. just months away. The next decade could build on problems that are brewing today. To gauge those issues, we spoke to prominent leaders on Wall Street with an eye around the corner. Ray McGuire, the president of investment bank Lazard, believes the failure to invest wisely in U.S. education is putting the country at a competitive disadvantage and creating risks to the American dream. TCW's Chief Executive Officer, Koch, sees an aging population creating challenges for the retirement system. And billionaire Wes Edens, a co-founder of Fortress Investment Group, who now runs New Fortress Energy and also owns stakes in prominent sports clubs around the world, he believes we are living in a perilous time, a world rife with geopolitical risks that markets have not begun to price in. Let's begin with Ray McGuire. We discussed how inequality in the United States education system is creating a permanent underclass.
The singular issue that will determine how our country fares, both locally and how we fare globally, is education. It's at the core of this. It's at the core of whether or not we have the opportunity to realize the American dream. It's also at the core of whether or not America can remain in the lead on the frontier of innovation and competitiveness.
So what's wrong with our educational system today?
The question is what's right with it? And I can't tell you that I find a lot. The returns that we're generating, if I put it in the context of returns, are unremarkable at best. At the national level, we spend $800+ billion, which may sound a lot. That's 3 to 4 to 5% of GDP, or of the budget rather, and we spend maybe 19, 20% of this on defense. Both are obviously important, but you can see the delta. Where we rank competitively in education, we have dropped, notwithstanding the amount of dollars that we've spent. We've dropped on a global stage. It used to be that we were in a premier position. Now we're in a secondary or tertiary position. If I look at degrees that are conferred in the higher technologies, most of those degrees are not conferred to Americans. And so I think about this geo-competitively, and I say that we are not doing that which we should be doing.
So if we keep going down this road, where do we end up in 10 years?
We'll see that there's an erosion in our competitiveness and our competitive standing. That is geo-competitively. If I look nationally at where we're going, we're creating a permanent underclass. So it used to be the case that education afforded us the opportunity to realize the American dream. Today, it's so stratified that a significant percentage of our population will never realize the American dream because there's an abject failure in those who today have been responsible for investing in education. We spend $35 to $37 billion a year in New York City education. If I look at the latest Nation's report card on the performance of black and brown students in the city, I would say 60 to 70% are below proficient. So I look at that and the returns, $37 billion, we need new investors. We just have to make certain that people recognize that education is fundamental to the realization of the American dream, the promise of the American dream, the hope. Without education, people have no hope. And we can see that being played out in urban America, can't we? Average age of the trigger puller is somewhere between 12 and 16 years old. So that means the kids who don't have hope, I can't read, I can't write, I can't participate in mainstream society. And therefore my value of life is going to be different, isn't it?
How dangerous is illiteracy in America today?
Illiteracy today reflects the abject failure of those who are leading in the educational world. And so we need to be urgent. Now, the challenge that we have is it doesn't poll. It's not hitting any polls, right? So there are other things here that poll at a much higher rate, at a much higher level, with much higher level of attention than what we see in the world of education. It is fundamental to who we are. And in the Brown versus Board decision, the Supreme Court held that segregated education was inherently unequal. We're now as segregated, if not more segregated, than we were then. So isn't what's at risk here the American dream? A permanent underclass of those who will never realize, never have the promise, the opportunity to realize the American dream? That's why it's imperative that I get new investors.
What about where we're investing in education? Is it more important at this phase to be investing in elementary, middle, high schools rather than higher education?
We need both. We need both. We need to have those people who are the best minds refined so in the world of quantum physics, quantum computing, STEM as you've outlined, that we remain in the lead. So we need to invest there. But remember, as a population between 0 and 3rd grade, we're learning to read. After that, we're reading to learn. And so if we neglect the entry, there's no remediation. Those children will never learn to read.
At the end of the day, this also comes down to jobs and opportunity and the ability to leave the educational system and enter the workforce in a way that can make you successful. What are the things that can be invested in today to help students have that realization at the end?
So we need to access students where they are, right? So I'll give you an example. In Lancaster, Pennsylvania, there is a place called Spooky Nook, which is a massive sports complex. And we take our son there, plays basketball. I got 800 kids playing basketball Saturday morning with parents. So if I meet them there and then somehow begin to integrate education into that experience, now I've got a formula that can begin to meet kids where they are.
Do parents need more support in helping students be successful?
Parents do need more support because what we've created here, the crisis that we've created, has become more intergenerational.
How do you think that building up America's system of colleges works in the future?
We need to invest across the landscape, from the state universities to the private ones, from the Georgia Techs to the Caltechs, from CUNY to CUNY and SUNY to Yale and Harvard. We need to invest, and we need to have the best. Remember, I got to invest in the faculty. I got to invest in the teachers, investing there so that they can invest in the schools. But I need to invest in the principal of the schools and the teachers there so that they don't have to go and use their own hard-earned dollars to buy crayons and toilet paper. Get me there. Get me the fundamentals here.
What keeps you up the most at night about this issue?
Just the negative impact. To the extent that were any one of our children, we would not allow a catastrophe like this to persist for as long as it persisted. We wouldn't allow it to persist one day. Given
the polling issue that you're seeing and given the issues around funding, do you worry that the problem gets a lot worse before it ever gets better?
I do worry about that. There's a fundamental worry that I have that without addressing it with a level of urgency which is today required, that it worsens. We're already in a catastrophic phase, systemic challenges, and will worsen unless we address it. The consolidation of the issue is that this is the most fundamental right that we have as a country, which is to educate our population.
Sounds like something we've taken for granted.
We have taken it for granted, which is a great way to think about it. Unfortunately, we can no longer take it for granted.
Coming up, Katie Koch, the CEO of TCW Group. This is Bloomberg. Welcome back to The Next Big Risk. TCW CEO Katie Koch worries that there's a silver tsunami on the horizon with an American population that will live longer. It's something that their retirement plans are not prepared for, as the risk of saving for the future moves from the hands of the government to individual savers.
People are living substantially longer today. Specifically, we now have a lifespan that's 20 years longer today than it was in 1960. As of 2020, for the first time, we had more people over the age of 60 than under the age of 5. And this is going to continue. If we look out over the next decade, two interesting things are that 100% of baby boomers will be 65 and over, so of retirement age. And we also have the possibility, because of advances in healthcare, that will add another 6 years of high quality life. So it's really good news for humanity At the same time, it's creating some kind of interesting disruptions to the investment opportunity set and, of course, challenges to saving for retirement.
When you think about this longevity risk that exists, what are the implications for society as the retirement burden falls more on individuals?
For much of the history of the last 100 years, let's say, the burden of retirement for Americans was really dealt with by the government after the creation of Social Security, and also by corporates through the defined benefit pension plans. The burden of that has now switched to the individual. And if you look at that number today, only 3% of Americans have access to a defined benefit pension plan. 60% of Americans that do have access to retirement savings, so it's obviously not even all Americans, but the ones that do, it's in a defined contribution plan, which means that the risk has shifted, again, from government and corporates to the individual. And then at the very moment when that burden has transferred to individuals, we have already seen, and we think we're going to continue to see, a migration of some of the most attractive income-producing assets from public to private markets.
What does this mean for the ability of the average American to access income-producing assets? Is it almost impossible these days?
I think there are a lot of solutions to these challenges around retirement, just to tick through them. First, people could, in fact, work longer. The second is that we have to reimagine defined contribution plans for those participants. The third challenge and kind of solution around it is that we do have to hunt more for these income-producing assets. And we need to incorporate some of the things that have gone to private markets into retirement portfolios for clients. As you know, I worked for a very long time in public equity markets, and those markets over the last 20 years were massively disrupted by private markets. And I think we are at the very early stages of fixed income being disrupted and a movement of these income-producing assets from public to private markets. We've seen that in the rise of private credit pre-global financial crisis. That asset class basically, didn't exist, and now it's well over $1 trillion. And that is taking share from the BSL or bank syndicated loan market. And then there's the securitized market, asset-based finance. And so we have, in many of our portfolios, us as well as our peers, do have the ability to invest in some of these illiquid assets. And we need to do some of that where we can on behalf of our clients. And then I would argue that we are going to have to create more product for the defined contribution space that can give dedicated exposure to some of these less liquid assets that may have higher income production than what's available in public markets.
So, when we think about people living longer, what are the forces that are driving longevity at this point?
The main reason that people are living longer is kind of found at the intersection of healthcare and technology. It is going to create innovations that are going to drive this persistent increase in longevity. And with that, that's obviously bringing tremendous investment opportunities for our clients.
There are questions of whether the existing opportunity sets are enough to help people invest through a longer lifespan. How do you rethink how you put money to work?
Healthcare is obviously one that we've already talked a lot about. One less obvious one is how we're thinking about navigating the real estate landscape. We are very positive on residential real estate. We have an elevated rate environment, which is keeping people in their homes. But longevity is also a key tenet of this investment thesis for us. And the reason for that is that the older population is staying in their homes longer. In fact, home ownership rates for people 65 and over are 80%. We've been quite public in our concerns about one of the largest components of commercial real estate, which is office. There are other parts of commercial real estate that are of interest to us. And again, one of them comes back to longevity, which is around senior living. So there is a silver lining here, pun intended, in leaning into aspects of senior living in commercial real estate. That would include independent senior living, assisted senior living, memory care facilities, lab space, hospitals, all of the things that are going to require new square footage to be put in to address this longevity trend.
Do you consider that America risks Japanification, that there are some structural issues here that could really inhibit growth of the country if we don't get this longevity issue and long-term investment issue solved?
I do want to say that demographics are an incredibly important thing for us to think about as investors. Demographics are destiny in some ways. They are the most important driver of what growth trajectory looks like. And clearly in Japan, it's been a very large headwind to growth. I do think the aging population in the U.S. clearly presents a headwind to growth. It is, however, offset by the fact that we have a more friendly immigration policy, which should actually be more of a tailwind to growth. I will say that we do think about it in the context of rates as well. I am, however, continue to be very optimistic about the growth trajectory of the U.S. Because we do have this offset with immigration, and also because it's a very innovative country that should drive productivity and growth, as captured, by the way, in all of the healthcare advances that we've made that have created this longevity problem, but also opportunity in the first place.
Coming up, Wes Edens, the co-founder of Fortress Investment Group. This is Bloomberg. Welcome back to The Next Big Risk. I'm Sonali Basak. When Wes Edens isn't busy co-owning NBA and Premier League teams, he's the co-CEO of energy firm New Fortress Energy. Wes is also known for co-founding private investment giant Fortress. And with capital deployed all over the world, Wes is concerned markets aren't pricing in the right risk premium for geopolitical risks.
So I'd say the risk that is something I think about all the time because it's in our life every day is really the geopolitical risk, the rise of that risk over the last several years, and what the real risks would be kind of broadly should there be any real conflation of that.
When you think about this risk, is it mostly as a citizen or is it as an investor?
You look, 50% of the world's population is going to elect a new leader next year, so it's a particularly charged time for that. There's been so much growth economically in the last 20 to 30 years with globalization, and I feel like we're in the big deglobalization trade. People want to move, semiconductors back on shore, manufacturing back on shore, and all that kind of thing. And then, these regional conflicts that everyone seems to think are going to be contained, whether it's, Israel, Hamas, or China and Taiwan, Russia, Ukraine, et cetera. I think are not really pricing the possibility, not the probability, but the possibility that something greater could happen. So it's a perilous time, I think, for both economies as well as individuals.
You think about this as an investor. You mentioned you don't think people are pricing in the issue. So how do you start to? The
simple way of thinking about it, of course, is that globalization was the source of a lot of growth without inflation. Deglobalization is kind of the opposite. And so, of course, what that could mean is just higher inflation, higher costs, higher interest rates, a lot of different things. What would cause inflation to spike? Are there inflationary forces that investors are miscounting? The U.S. is, current deficit, $34 trillion. It took us 200 years to get to the first trillion, and we've managed to add that up 34 on top of it. So, and what that means in terms of people and consumers is that there's competition then for borrowing and for capital. And if the governments are going to be your biggest competitor, it's likely you're going to have much higher rates for a much longer period of time in the long term, perhaps after the short, reset. And I think that, the risk of higher interest rates is one that people don't think about, as much as they should. Is that directly related to the geopolitical risk out there? Well, I think geopolitical risk can actually add to that, right? So I think that, again, instability in the world is likely to have significant swings in this. And so, the interest rate component, when I started working on Wall Street many years ago, current coupons were 12, 13, 14, 15%. So much, much higher rate profile than what we have today. And I think people have become used to these much, much lower rates. And the question I would ask to people as investors is, what happens in a world where rates are actually much higher for a longer period of time? I think that can be very, very destabilizing. There are a lot of concerns that a lot of this decoupling of countries, a lot of the conflict that we're seeing in different regions could lead to a spike in energy prices. How concerned are you, and how much do you think energy pricing can change in the next couple of years because of it? Well, you're going through a period right now where, oil prices are falling and there seems to be an abundance of oil. But whenever I ask the question, we have to discuss the topic of energy transition, my perspective is, although it's great to have, all the renewable, policies, and it's something we are ourselves, very involved in and adamant supporters of. It's going to take a long time before there's true defossilization of these. And so I think we should all be prepared to be using oil and gas in our daily life for a long time. And when you have a significant part of your cost structure that can move up and down in price significantly, that adds a lot to the volatility of the framework of your business.
You worry about the pricing, but what about just the economic security, the energy security involved when you think about these escalating conflicts?
Well, it's a really good question. When you look at what happened with the Russia invasion in Ukraine, and they shut off the gas to Western Europe, that all of a sudden energy security, which wasn't on everyone's lips, became the thing to do. And they responded quickly by building, terminals to bring in gas. It looks like they've done a good job of managing it. But energy security was not a topic that was on the top of people's minds. That, again, gets right at this kind of deglobalization trade. There's just a lot of uncertainty about how the countries are going to work with each other. And that results in just a higher uncertainty coefficient that you have to get paid for it to be a fair investment.
You had mentioned you don't think that a lot of investors are pricing in a lot of the risk premium required for the geopolitical risks that we're facing. How is it possible that so many investors are discounting it at a time where we've seen major wars break out in the last 4 or 5 years?
They haven't really manifested themselves broadly in a way that has impacted a lot of people. I think if you were affected directly, you did pay a lot of attention to it. If you didn't, you were able to kind of ignore it, and it kind of moderated itself and kind of went away. And that's really my point. I think that there are a number of these significant geopolitical circumstances that exist. For the most part, we're all kind of counting that they're not going to turn into something broader, which of course is what we hope, but it's not a sure thing.
Is there a worst case scenario that you plan for, and what does planning for it look like? Worst case, what we do take a very hard look at is like, where do you want to have your capital exposed? I think where it probably manifests itself with us is on the leverage side. We want to be as unleveraged as possible, and we're in businesses that generate a lot of cash flow, and so you're going to end up reinvesting that in your balance sheet to kind of bring down leverage, in a fairly significant way. I think businesses that rely on a lot of leverage and will rely on it going forward, they just have a lot more exposure to it. In my mind, I think also, how do you calculate? How do you calculate the risk premium embedded in this question?
Am I more worried about investment or civil unrest? I do think what you're seeing right now in immigration is a real challenge in this country. I mean, this is a nation that's built on immigration, so that's kind of the heart and center of the U.S. This illegal immigration stuff to me seems worrying because A, we need a lot of immigration here because demographics is destiny as you do it, but B, it seems like it should be a lot more lawful. And I think that that's the kind of thing that really kind of gets people very exercised.
Do you think this idea of deglobalization adds to this issue, this more nationalistic policy that you're seeing in many countries?
I think that's a great way of putting it because it creates this us versus them as opposed to we and us.
Do you think that deglobalization is bad for the economy writ large?
For sure. I mean, I think that perhaps it went too far the other way, where we basically didn't price out any risk of decentralizing all that we actually manufactured, and then you came with these big supply chain problems during the pandemic, and it became very evident that maybe that wasn't a perfect idea. I think the pendulum could easily swing too far the other way, and if it does so, then you're not taking the benefit of low-cost labor or low-cost materials or other things around the globe. So these things are very, very hard to moderate those cycles. We have a challenging enough time in this country managing our own economy. We try and do that, writ large across a lot of different economies. I think it's actually a very, very difficult thing to manage.
That's it for this episode of The Next Big Risk. You can watch previous interviews on Bloomberg.com and the Bloomberg Terminal. I'm Sonali Basak, and this is Bloomberg.